The city pays respect to all Indigenous people and honors their past, present, and future. We recognize and respect their cultural heritages and relationships to the land. We only have one item of business for this special meeting, and that is Energy Business Strategic Review. And we have KPMG with us and a number of people from our energy department. I will turn it over to City Manager Mitchell.
Thank you, and through the chair, I just wanted to turn it over to Managing Director Pankos for an introduction and to thank her for this very large piece of work that she's shepherded through over the past 9 to 10 months. So thank you, Managing Director Pankos. And without further ado.
Thank you. Through the chair, I'm very pleased to welcome KPMG representatives today, both in person and online. In person, we have Karen Gurecki and Tim Swanson, and online we have Ross Homeniak and Sean Barraclaw, and I believe Ross will be providing an introduction on behalf of KPMG before we move into the presentation. So welcome, Ross.
There, had to make sure I was off mute. Good evening, Madam Mayor, members of council. Thank you very much for joining us this evening. My name's Ross Homeniak. I'm a partner with KPMG with our infrastructure advisory, and I've had the pleasure of overseeing our work with the city on the Energy Business Strategic Review. Our work has taken an objective look at the city's energy business, its assets and operations, and at go-forward service options given declining performance, growing financial and regulatory pressure, and the evolving Alberta energy market. Our goal today is to deliver the findings of our review, highlight the underlying analysis we performed, discuss the strengths and weaknesses of go-forward options for the business, and provide you with an opportunity to ask questions. In our role as advisor, we've brought to bear distinctive experience and expertise. This has included a multidisciplinary team that understands municipal governments and utilities and how they operate, with the knowledge of energy transition from a business, regulatory, and technical standpoints. A comprehensive approach to business models and service delivery that provides an objective means of qualitatively and quantitatively addressing strategic business options. Knowledge and experience of working with the evolving energy landscape in Alberta and across Canada. We provided the city with a comprehensive and actionable report based on unbiased, pragmatic, and systematic analysis backed by proven experience. This information is meant to support you in making an informed and effective decision as to the future direction of the business and on the steps needed to effectively move forward. With that, I'm going to turn things over to Karen, who's going to carry forward with our presentation. Over to you, Karen.
Thank you, Ross. Forward. Thank you, everyone. I want to start off with some project context. So we recognize that the energy business has been a key part of Medicine Hat's culture, and that it's part of your identity since the early 1900s. It's provided you with employment and affordable and reliable services, and a steady source of municipal revenue. Its success epitomizes the city's strength, independence, and ingenuity, and it's a significant source of community pride. The conditions upon which we were conducting our strategic review are changing. While the energy business has flourished, now we see that local natural gas production is declining, that there are significant reforms in Alberta's electricity market, and there is a transition to a low-carbon economy and power system, which means that the energy business will be facing federal clean electricity regulation or some form thereof. Therefore, all of these factors will impact the city's ability to economically generate electricity with its natural gas-powered units. We know that the catalyst for this study and for this analysis began with community interest in the significant increase in rates during the summer of 2023. And in response, the city responded by investing $33 million in cost relief to consumers and commissioned a study on the energy business, on the electricity generation business model, and subsequently distribution was added through conversation with the city. So additional project background, through an RFP, the city engaged KPMG to evaluate your strategic options for the energy business to deliver optimal value for the community in the light of these changing circumstances that I described. The project objective was to conduct a strategic review to help the city decide on a business model for its energy business that intended to deliver optimal value for the community in light of these changing community and external circumstances. And when we say, I'll get into the criteria, but when we say optimal value for the community, we considered both the ratepayers as well as taxpayers. So within scope, we looked at the ownership model, the potential benefits and impacts related to rate and dividends, an overall strategic approach to ensure that there was best value, as I mentioned, for the community, while we are competing trade-offs and complexities, including short-term and long-term interests of business, municipality, ratepayer, and taxpayers. Also, we needed to consider the Electricity Utility Act and other regulatory constraints, as well as energy transition requirements. So we have fairly detailed scope and related limitations that we outlined with the project team. But in general, we determine within scope, we determine an overall strategic approach to ensure best value for the community, as I mentioned, determination of an ownership and governance model, and looking at certain rate setting approaches. However, the design of a specific rate setting methodology was excluded from our analysis. Also excluded from the scope was determining potential market value for the energy business assets based on a potential sales strategy, as well as any municipal budget decisions, such as determining the best value use of heritage funds. So KPMG engaged in a 5-phase process where we began with a project initiation, and then all subsequent phases, we delivered a report to the city to outline the findings for these phases. Those phases included a current state assessment of the energy business, then a strategic assessment, including a SWOT analysis as well as a PESTEL analysis, and then finally a detailed options analysis, and finally the final report. That included our full business case report as well as a public report. And I'll get into more of the details of our analysis in another slide.
So before we get into the analysis that we'll be walking through today, we thought it'd be helpful just to take a moment and review the energy business as a whole, just to understand exactly what we're talking about when we're using the phrase the energy business and how it works. So what we have here is a simplification, I would say, of the complex business that is the city's energy business. The first thing we note is that it is fully integrated. So that you're producing your natural gas, you're distributing your natural gas, you're producing your electricity, you're distributing your electricity. That's not to say that it operates entirely in a bubble, Currently, it does tap into both the broader natural gas system as well as the broader electricity system in Alberta. In fact, approximately 85 to 90% of the natural gas is being purchased from outside of the city. The electricity also taps into the electrical grid, and it is currently purchasing electricity from the rest of the electricity market, as well as selling electricity to the electricity market. When we look at the cash flows or the monetary flow associated with the business, we start with two sources of revenue. The first one is obvious, that everybody's very familiar with, and that is what the customers are paying, what the ratepayers are paying for their electricity and for their natural gas. In addition, there's a second source, and that is when we do sell electricity to the energy market, we're earning revenue from the electricity exported. The use of that revenue, the use of the proceeds from those sales, goes towards covering all the operating costs of the natural gas production, electricity generation businesses, electricity distribution and natural gas distribution businesses, as well as the procurement of electricity and natural gas when we buy it from the broader market. Proceeds that are left over after that are used to repay debt associated with the investments in these businesses in assets and in additional sustaining capital. So sustaining capital is investment in assets to keep them renewed. So as assets are aging, we're replacing them with newer assets. Any money left over after that is given back to the city in the form of a dividend. When we think of how rates are typically set in the utility space, there's a couple of things to keep in mind. The first is regulated rates. So this would be the rates we pay for the distribution of our natural gas, the distribution of our electricity, and for the energy prices that we pay for electricity and natural gas. These regulated rates are based on allowed costs, allowed by a regulator, a return on invested capital, and that return is commensurate with the risk associated with the business unit. To protect rate holders' interests, an independent regulator reviews and approves rates for these different regulated prices. And they're reviewing them to make sure that they're justified in terms of the costs are appropriate and necessary, and that the investment in the rate base that underpins the investment in the assets is needed. Now, in Alberta, we have a deregulated electricity market. And so in the broader Alberta market, prices are set for electricity based on the supply and demand for electricity on an hourly basis. But still, jurisdictions in Alberta regulate the distribution rates and the rate for electricity, which is now referred to as the rate of last resort. In the City of Medicine Hat, through its exclusions under the Electric Utilities Act, does not have a competitive retailer for electricity in the city. So we operate on the rate of last resort as well as other options that the city has provided in the past through contracts. The rate of last resort is basically reflective of the cost of the electricity provided. So when we look at these rates in other jurisdictions, we might see some jurisdictions setting their electricity rates based on the cost of generation. And these would be, examples would be, for example, SaskPower in Saskatchewan, BC Hydro in BC, where we have a regulated integrated utility. And they're earning a regulated return on their generation assets. In Alberta, we operate, as I mentioned, in that deregulated world of generation. And so our electricity prices are based on the supply and demand characteristics. Therefore, our regulated rates tend to be in Alberta, tend to be based on the cost of procuring that electricity from the market. So why that's important for the city of Medicine Hat is when we look at the projections now for commodity prices in Alberta, we note that we're anticipating, and we will be providing a fair bit of information on this a little bit later on, we note that the anticipated power prices are going to be significantly lower than they have been in the last few years. And that means for the city, it may be cheaper to purchase power from the electricity market more often than it has been in the past. So the city's electricity generation units are going to be faced with higher fuel costs, higher environmental costs. Their costs are going up. The market price for electricity is coming down. So our opportunity to operate at a rate lower than the rest of the market is going to be reduced.
We have a question from council. Councillor Van Dyke?
Yes, thank you through the chair. So that assumption is based on our current thermal generation only, correct?
Correct.
Okay.
Yes, that's a very good point. Yeah.
Thank you.
Yeah, the statement is just based on the generation assets you currently have.
So in the event of the addition of solar, that would maybe no longer be the case? The thermal would still be more expensive, but the solar would not?
Correct.
Thank you.
Yes, yes. And often, different companies do it differently, but most generators will bid their assets by type, right? So you'll bid a solar or a wind farm differently than you would bid a natural gas plant. Thank you. Yeah. So what this means is we actually would anticipate that it would be more expensive to do to base your electricity rates on the cost of generation than it would be to buy more power from the market at market rates over the next few years. Okay, I'm going to invite Karen back to walk us through some of what we see in terms of the shifting landscape of the energy business.
Thank you, Tim. So this slide provides an overview of the strategic assessment that we conducted for the energy business, and we'll get into the details, but at a high level, these were our findings. So based on this changing market and regulatory landscape, we see increasing risk to the profitability of electricity generation, as well as the natural gas production business units. While historically, natural gas production business was profitable, it is now facing the high costs of asset retirement obligations, or AROs, and significantly declining production, as well as lower market prices. In addition, in recent years, the energy business has been highly reliant on profits from electricity generation. However, this profitability is at risk because of the fact that the Alberta power market is undergoing changes from a policy and regulatory perspective. As well, the city's natural gas generation fleet, gas-fired generation fleet, is becoming less competitive relative to the market. As well, the city's or the energy business's GHG or greenhouse gas compliance costs are increasingly becoming more and more significant. We see that achieving a fair and appropriate return on rate base will likely be a priority for the distribution businesses, as they need to invest significantly in growth and sustaining capital over the next 10 years. Finally, we see that the business value of the energy business may be suboptimized by the governance model currently used. Due to the reality of elections, council do not naturally have the energy and utility-focused technical expertise, and lack of independence to perform their functions as rate regulator and board of directors. This complexity is only expected to increase and grow in the industry due to changes in the Alberta power market and the energy transition regulatory changes. So that first point I mentioned, as you can see from this graph, on the y-axis, it's 1,000 cubic feet of natural gas. And on the other side of the y-axis, it's barrels of oil per year. Natural gas is the blue bars, and oil is the pink line. And between 2019 and 2023, the city's wells saw a significant drop in both natural gas and oil production due to depletion, divestitures, and implementation of an accelerated abandonment program for assets deemed uneconomical. And as mentioned, Sean Barclough is online, and she'll be taking over for the next 4 slides.
Hi, good evening, everybody. Tim and Karen have both referenced some of the challenges and changes with respect to both the environmental regulatory environment and the Alberta power market. So I'm going to just dig a little deeper into that and also talk about the assumptions that have been used in the strategic assessment analysis. So starting with emissions regulations on this slide, what you can see is the city's projected annual greenhouse gas compliance costs for its power generation fleet under the existing Provincial Technology and Innovation Emissions Reduction Regulation, or TIER as it's called, under business as usual assumptions. So I'm going to just focus on the chart up to 2030, as that's based on already public and published TIER regulation. Beyond 2030, the data you see on the chart represents a forecast, which is based on reasonable but not certain assumptions with respect to what could happen from a greenhouse gas compliance cost framework perspective. As you can see, the chart shows a significant increase in the city's annual TIER compliance cost based on business as usual generation assumptions or generation levels similar to the past few years. This increase in compliance costs is due to increasing stringency of the TIER emissions intensity performance threshold and increasing dollar per ton compliance costs in TIER. And then that's coupled with the reality that the emissions intensity performance of the city's natural gas power generation fleet remains unchanged. And I would note, just based on the earlier question, this is under the assumption that the fleet is status quo, i.e. the natural gas generation fleet that the city owns today. In a business as usual case, the city's GHG compliance cost would be projected to increase over manyfold from 9.7 million in 2023 to over 40 million by 2030. As noted, this chart does represent business as usual, however. And because the city's current generation fleet is 100% natural gas fueled, TIER will increase the energy business's costs of generation disproportionately compared with Alberta power companies that have more efficient and lower emitting generation fleets. As a result, there is the real potential that the city will see a material reduction in the total annual volumes of electricity produced, with the potential for imports to be cheaper in some periods, as Tim referenced, and a material reduction in exports to the Alberta power market, which would reduce revenues. In this case, because of the lower generation, carbon compliance cost would be lower than shown in this projection, but that comes along with also, lower revenues and increased costs from an import perspective. We can go to the next slide, please, Karen or Tim. So moving to the proposed federal clean electricity regulations. This regulation is intended to support a net zero electricity grid target as part of broader efforts to transition the country to net zero emissions. As currently proposed, these regulations would only allow very, very low amounts of GHG emissions from electricity generating units from 2035 onward. These regulations are intended to drive physical compliance with very limited allowance for financial compliance. These regulations represent the current federal government's draft proposal for achieving a net zero electricity grid by 2035. However, as we all know with the pending election, it's likely these regulations may change. However, it's anticipated that large final emitter decarbonization requirements, such as those that apply today to the city's fleet, will persist regardless of the governing party, albeit with the potential that timelines may be extended. In addition, a provincial large industrial compliance framework, tier or something similar, is expected to remain in place in the interim. Combined, the tier and CER or other future federal regulations are expected to drive higher greenhouse gas compliance costs, a reduction in thermal generation, such as natural gas-fired electricity units, and an increase in net zero generation technologies, including wind and solar electricity generation. The development of new renewable power generation projects in Alberta, however, may be impacted by recent more stringent permitting requirements introduced by the Alberta government. So if we can go to the next slide. So moving from the emissions frameworks to the Alberta power market, the past few years have seen several Alberta government initiated reviews related to the power market, addressing questions around integration of increasing renewable generation, system reliability, and the exercise of market power resulting in higher prices to consumers. You can see the reference there to the AUC's Module A and Module B and interim market power mitigation regulations. But now we see the AESO, under the direction of the Alberta government, is currently in the middle of industry consultations on its restructured energy market initiative, which is expected to result in significant structural and rule changes in the Alberta power market. The changes include the introduction of a day-ahead market, additional ancillary services products to help manage system reliability, and permanent market power mitigation rules. These changes are expected to mitigate high prices and volatility while introducing increased system reliability with the expected increase in renewable generation as the system transitions to net zero. These changes may impact the city's profitability as compared to a business as usual scenario and may limit the energy transition generation technology options pursued by the energy business. We move to the next slide. So let's talk about the commodity view for the Alberta power market and natural gas market in Alberta. These graphs represent the commodity forecast used in the analysis performed for the strategic review. You can see the Alberta power price forecast and history on the left and the Alberta natural gas price on the right. Actual historical prices are to the left of the vertical line on both graphs, with the forecast prices to the right. For forecast prices, we have used publicly available information. For both power and natural gas, TransCanada Energy forward prices, which are prices based on actual forward market transactions, have been used for the years 2024 through 2027. For 2028 through 2034, Alberta power prices are from London Economics report used in the AUC's Module B process and also used in the AESO's 2024 long-term outlook for the Alberta power market. The London Economics report includes two decarbonization scenarios. We have assumed decarbonization of Alberta's power market by 2050 in the base case, with a sensitivity run assuming earlier decarbonization in 2035. I just note the 2035 decarbonization scenario is consistent with the currently announced clean electricity regulations, but I think there is expectation that if there's a change in government federally next year, that timeline is likely to be pushed out. Natural gas prices for the 2028 through 2034 period are from the Canadian Energy Regulator. Please note that the power price views do not necessarily or explicitly take into consideration potential changes to Alberta's market structure from the ongoing AESO restructured energy market process, which was discussed on the previous slide. So key takeaways from this slide are that Alberta power market prices from 2021 to 2023 were very high compared to historical prices and expected future prices. The market does not expect these prices to remain high going forward. In fact, 2024 has already experienced a significant drop with the addition of a large amount of new generation capacity coming onto the Alberta market. Prices are expected to continue to drop over the next few years before beginning a steady but muted upward climb. Alberta natural gas prices have also dropped materially in 2024 from the previous high levels seen in 2021 to 2023, and are expected to start to increase again toward the $4 per gigajoule level. So the combination of these two things, power prices increasing at a lesser rate than natural gas prices, along with increasing GHG compliance costs, as we discussed, will reduce the margins available for the city's electricity generating assets. As a result, opportunities and revenue available to the city's generation fleet are expected to be much less than what has been seen over the past several years. And if we go to the next slide. So to summarize the key takeaways from the emissions and commodity markets and regulation discussion that we've just had, there's a material level of uncertainty and risk related to both power market and emissions regulations and markets today. Fundamental changes to supply and demand dynamics in the Alberta power market are expected to materially reduce city revenue from the electricity generation business going forward compared to recent history. Anticipated changes to the Alberta power market structure and regulations may affect the city's ability to capitalize on opportunistic market participation as it has done in the past. And emissions regulations will continue to drive up the cost of compliance for the city's power generating fleet, while under proposed federal regulations, all the units at the main plant would be required to comply with CER in 2035, with Unit 16 subject to compliance in 2038 and Unit 17 in 2042.
I have a
None of the
question.
cities.
Sorry, I have a question from council. Councillor Van Dyke. I wasn't sure how, are you?
I'm nearly done if you just
Okay,
want to give me.
yes, go ahead.
Okay, sorry. So none of the city's units would meet the anticipated emissions limit that's proposed in CER today on a unit or pooled basis. As a result, these assets are at risk of forced shutdown with proposed federal net zero regulations. So this high level of uncertainty and risk certainly has implications for the city's financial stability. So I'll pause there and happy to take a question.
Thank you, through the chair. Apologies, I didn't mean to interrupt. I had a question
That's okay.
around the commodity forecasts. So I know we've heard in our committee meetings and minutes to people that don't attend committee meetings about how soft the market has gotten and the anticipated softness going forward. However, there's changes all the time in the market, and I know that the current provincial government is actively pursuing bringing data centers to the province, which, as we all know, use enormous quantities of power and could change the supply and demand landscape significantly depending on how many of them came here. So has any of rapidly changing technology or economic opportunity been factored into the market outlook?
Well, yeah, I mean, I guess I'd say I would agree with you. There's always, I mean, a forecast is a forecast and it's always subject to risk and change. However, the demand forecast does assume growth from various aspects and will have considered things like data centers, not to say the demand growth could not be higher than forecast. On the supply side, however, the most recent additions have brought onto the market, I don't have the exact number, but somewhere in the magnitude of an incremental 2,000 megawatts have been added from the Suncor, Cascade, and Capital Power repowering project. And that is just a very significant change to the supply-demand balance in the province. And I don't think, certainly not in the short term, and would we expect to see that excess supply eroded anytime soon. I'd also note that the forward markets, which are used for the first 4 years here, I mean, similar to the fundamental forecast, but the forward markets are actually based on transactions. And those transactions will take into account any known information in the market, and are based on transactions between sophisticated parties who would be following, what is going on in the market, their expectations around the demand side, expectations around supply. So I guess I would suggest that while I agree with you, there can always be changes. We could see more demand come on than has been assumed. I do think that, to expect that this is going to be a dramatic difference or back to the levels we've seen for the past few years would be highly unlikely.
Thank you.
Sean, just to maybe put that into context too, when she says 2,000 megawatts, I believe our market, just pulling off the top of my head here, our market max demand is currently about 12,000 megawatts. So 2,000 on top of 12,000 is a significant increase in the total market supply.
And Tim, one other thing I'd add is also that the assets that have come on are highly efficient natural gas units, with significantly more efficient than the city's natural gas units based on their vintage, so being brand new technology, and also their size. So scale matters when you're looking at efficiency in power generation units. So yeah, to Tim's point, we're talking about somewhere in the range of probably 15% incremental supply, and also of highly efficient natural gas units.
There it goes. Sorry, just delayed reaction with the clicker here. So we've been talking about some of the findings through the analysis, and we've really focused on some of the uncertainty in the market driven by, in particular, a lot of the regulatory changes we're seeing. I'm going to turn a little bit to some of the findings that are more internal and some of the observations we made through our assessment of the business. So the first one is that we feel that currently business value may be suboptimized, and that in fact the governance structure of the energy business may be a contributing factor to that. So what do I mean by that? We note that capital projects for the energy business follow the same capital budgeting and capital approval process that any capital expenditures within the city follow. And so that means we're evaluating energy projects in the same way we'd be evaluating new roads or building upgrades or those sorts of things. And I would suggest that the criteria used to do that is different than the criteria that would be used if you were only looking at energy assets for the purpose of building the resilience of the system and generating a reasonable return. The second thing is that we do see that some of the accounting for the energy business obscures a little bit some of the actual performance and some of the costing that goes into determining the rates, et cetera. And so there may be some elements of that are resulting in decisions that may not be optimizing the business value. And this may be contributing to some of the inconsistent returns that we see on the distribution businesses. So this is the natural gas distribution business as well as the electricity distribution business. A distribution business is, if we look at other comparators in North America, we would expect to see these generating a very consistent return. And it's based on the growth of the system that they serve and the regulated return on what we call the rate base, or the assets invested in the system of distributing the commodity. What we saw in the city's energy business is some more volatility than we would expect to see. And I think some of the rationale or the contributing factors to that are things like there are differences in how the municipality accounts for things than a standalone business might. So for example, how it treats developer levies, it would be different with the city than it would be with a standalone energy business. We also saw that there were differences in forecast and actual depreciation, something that is not common in energy businesses, and that actually does have a material impact on things like the required revenue to cover the costs of the business. And the third thing that is very typical in the utility business is the use of what we call rate riders. And these are basically true-ups. So if at the beginning of the year, when a utility goes to the rate regulator and says, we need to charge this rate to recover our costs, they're basing that on an assumption or a series of assumptions about the volumes that they're going to sell, the costs that they're going to incur, and as a result, of course, with the volumes is the revenues that they will receive. As the year progresses, costs change, volumes change, and the utility could over or under recover in any given year. And so those over and under recoveries are reflected in future years through rate riders to, if you will, true up the difference. The city has not used the rate riders historically, and so any losses that the distribution companies have experienced, they have not been able to recover those in subsequent years. So this becomes all the more important when we start to look at the next 10 years. And just looking at the distribution, looking at the energy business as a whole, we're looking at almost $500 million worth of investment. In a big number, but in fact, over the past 10 years, it hasn't been all that much lower. The next 10 years expected to be higher, but if we break, oh, sorry, my apologies. Wrong slide there. So, if we look at the next 10 years, that $500 million is front-end loaded. So we're looking at a few years in the short term here that could be very heavy in terms of the required capital investment. And this is not to build anything new, really. This is to keep up with the existing, maintain the existing asset base so that it is current and it is, replacing assets as they're reaching their end of life. And there is a little bit of growth as we meet the needs of a growing city. So to retain the reliability of the system, we're looking at this kind of investment. These are big dollars pitted against the rest of the city's capital budget. So understanding the relationship and how we deal with the energy business's capital versus the competing priorities of running a city is going to become, I would suggest, a focal point or could be a challenge. The $500 million is actually before we start to look at some other kinds of expenditures associated with the regulatory risks and some of the other uncertainty that we've been talking about. So for example, that does not include the cost of investing in emissions reduction technologies or low emission generation.
I have a question. Doesn't that $500,000 have to come from ratepayers one way or the other?
Well, the portion that would be coming from the distribution companies, the portion of the investment going to the distribution companies absolutely is recovered directly from the ratepayers. The portion that would be used to support the energy generation business indirectly would be. Hopefully we're offsetting that a little bit with some revenues through export, although that is, as we pointed out, going to be more challenging.
But that's the situation no matter what, like that amount of money has to come from somewhere.
Yes.
Okay.
Yeah.
Thank you.
For sure. Yes. So, things that could require a significantly greater investment than that $500 million are, as I mentioned, the investment in lower emission technology, strengthening the interconnection of the transmission grid, and potentially increasing some of the physical and cyber security of the system. This brings to light, I think, another significant challenge that we noted, and that is when we look at the governance of the energy business. We see three very different and very important roles, governance roles, that at times may have inherent conflicts. So the first is we see that we need to govern an energy business. We need to make sure that the energy business is making sound business decisions and that it is operating as efficiently and effectively as it should. We need to make sure that we're protecting the interests of the citizens, the taxpayers of the city. And thirdly, we need to protect the interests of the ratepayers. Right now, that governance responsibility for all three functions rests with you, with council. And this is a daunting task. There's a lot of technical knowledge required, especially when you're talking about the rate regulation. And thank you. Especially when we're talking about rate regulation and with the energy business, having a working knowledge of some of the challenges that the energy business is facing, I think is going to be very important to help it navigate some of the challenges we put forward. So we see that it is possible that this governance structure may be contributing as well to sort of suboptimizing the overall value being generated through the energy business by not potentially giving as great a scrutiny as may be required on the business itself and its investments and its path forward. And we want to make sure too that there's the appropriate amount of scrutiny on the rates and the transparency and understanding there. So that sort of sets up, that provides the landscape, I guess, and the lens that we were considering when we started to get into looking at some of the options and evaluating how might we deal with these challenges going forward. And Karen is going to walk us through those options. And she'll be much better about advancing slides.
Thank you, Tim. Speaking of which, we'll advance our slides. So KPMG looked at multiple options when it came to our options review, and we narrowed it down to 3 options where we focused the majority of our efforts. And we considered these 3 options for each of the 4 business units within the energy business. So that's electricity distribution, natural gas production, natural gas distribution, and electricity generation. And so the 3 options that we looked at in detail are the status quo, municipal department, where the energy business is, or the specific business units assessed would stay within the city. And as I mentioned, this is status quo, or business as usual. The second option that we looked at is a municipally controlled corporation, or you'll hear us use the acronym MCC. And this is where the energy business or specific business units would be moved into an autonomous but city-owned company. And thirdly, we looked at divestiture, where the energy business as a whole or specific business units would be divested in whole or in part so that the city would no longer have a controlling interest. And the next few slides, we'll look at these in detail. So there's several factors that we want to delineate these 3 different options from each other. So who owns the entity? The city department, under a municipal department, it would be a city department. Therefore, the city would maintain full ownership and control of the entity, as is the current state. As is the current state, council will continue to govern the business units under normal city policies and processes. Council would also continue to regulate the distribution and commodity rates. And the financing options for the business units would be that the city department finances any capital expenditures through surplus generated by the different business units, internal reserves, or tap into the city debt capacity. Moving into the municipally controlled corporation, or MCC. In terms of ownership, the independent company is majority owned by one or more Alberta municipalities. So under this situation, we were assuming that the city of Medicine Hat would own the MCC. Under governance, the MCC would operate independently from the municipal shareholder, that would be the city, and operate with their own executive team, as well as board of directors. And MCCs are required to execute a unanimous shareholder agreement, even if there's only one shareholder, and that is the city. In terms of who regulates the entity, council would continue to regulate the distribution and commodity rates under an MCC. So council would continue that role to regulate rates. In terms of financing, there's additional financing options. So retained earnings would be a source of financing, as well as direct access to debt markets. And this could impact the city's debt capacity, but not necessarily, as well as shareholder or city investment from the city reserves or debt. Under the divestiture option, in terms of ownership, divestment of all or a majority interest in the energy business or business units to a third party would occur. The purchaser would govern that entity, and the Alberta Utilities Commission would regulate distribution rates, transmission, or transportation and commodity rates. And in terms of financing, the purchaser would finance the business. So we're not going to dive into too much detail, but I wanted to outline the fact that KPMG has conducted a jurisdictional review to feed into our options analysis and help us guide which options we chose for fulsome analysis. We looked at 6 municipal energy businesses, the City of Red Deer, the City of Edmonton or EPCOR, NMAX in the City of Calgary, as well as Saskatoon Light and Power, Ottawa Hydro, and Electra Inc. And we found that most municipally owned energy utilities operate as corporations rather than municipal departments. In terms of governance, 2 were governed through city council and 4 were governed by independent board of directors. 2 continued to be regulated by council, whereas 4 are regulated by the utility commissions. From a generation perspective, 3 still own some level of electricity generation, but only 1 had significant amounts. And 3 divested all or a majority of their generation assets. In terms of a type of entity, 2 were municipal departments and 4 were municipally owned corporations. We also looked at other governance models. So we looked at the Regional Services Commission, a society, Rural Utilities Association, and these were all deemed inapplicable because they did not meet the evaluation criteria that we set out prior to undertaking our analysis. So moving into our options analysis approach. So we undertook 6 stages of our options analysis in our options analysis report. We first laid out, and I'll go through these in a minute, but some desired outcomes for the energy business and the City of Medicine Hat. We also laid out a set of evaluation criteria and validated these with the project team, but these were created by KPMG. As I mentioned already, we looked in detail at multiple options and narrowed it down to 3. Then we undertook quantitative and qualitative analysis on those options, and I will go through in detail the quantitative approach that we took. Then finally, we looked as a whole at the summary of our analysis on what our findings were, and translated that into a series of strategic actions. And those strategic actions are what we're going to be going through in detail with you today. We're not going to focus in detail on that, on the actual options analysis. But I will go through with you those desired outcomes that we laid out prior to undertaking the analysis. The desired outcomes, we knew that we wanted to consider the best interests of the ratepayers, residents, and the City of Medicine Hat as a whole. So dividing these into the desired outcomes for each of those groups, the ratepayers as well as the taxpayers. For the ratepayers, we wanted to ensure that the city's energy provider, the energy business, would be reliable, financially and operationally sustainable, and competitive with respect to rates within Alberta. From a taxpayer's perspective, we looked at the level of risk to which the energy business exposes the city and its taxpayers, and wanted to ensure that that level of risk is acceptable. And that includes the regulatory risk associated with the energy transition. We also wanted the city and taxpayers to receive value from their energy business, from the energy business, which is commensurate with the investment in and the risk associated with the business. And finally, we wanted the energy to ensure that the energy business would have access to the capital it needs to be reliable, operationally sustainable, and competitive. So we also laid out a set of criteria against which we wanted to look at each option. And there are 5 specific criteria looking at, the financial value and capital costs. Looking at the capital requirement, we wanted to ensure the option would enable access to the capital necessary to sustain the energy business. And that's capital for growth, as well as the energy transition and sustaining capital. We wanted to also ensure that the financial benefit for the city and the taxpayers measured by the net present value or estimated net present value of cash proceeds, it was determined by both of those factors. That is from the city and the taxpayer perspective. In terms of service delivery, we wanted to ensure that reliability and service quality would not be negatively impacted. From a risk perspective, we wanted to look at financial risk as well as regulatory risk, and that they are both of those profiles were acceptable to the city. Finally, from a rates perspective, we wanted to ensure that rates would not inherently and necessarily become uncompetitive. And from an implementation perspective, we wanted to ensure that the cost, effort, and risk are of the change that is potentially being considered does not negate the accepted benefits. So looking in detail at the quantitative analysis, we undertook 3 different levels of quantitative analysis. So first, we looked at the commodity rates modeling, and our objective was to project Alberta power prices and natural gas prices, which is what Sean presented to you. We wanted to use publicly available sources, as Sean's already mentioned, and she's gone through the details of using the TC energy forwards as well as the London economics forecast that was published in the AUC Module B with the 2035 price linear extrapolation. And we've also mentioned that the natural gas prices were based on the TC Energy forwards and the Canadian Energy Regulator. So also there were projections for both a 2050 decarbonization scenario and a 2035 decarbonization scenario and sensitivity scenarios respectively. In phase 2 of our quantitative modeling, we looked at, our objective was to project electricity generation imports and exports and their associated revenues and costs. And the results were generated for on-peak as well as off-peak hours for each plant. And the costs included projected transmission costs, fuel costs, maintenance, emissions and compliance costs, as well as imported electricity and the price of exported electricity. Finally, we undertook financial modeling with the objective of determining the project potential for the financial results for each business unit. And we looked at projections for electricity generation based on the outputs from the modeling of generation imports and exports, and the historical costs were used for fixed costs. Projections for the distribution business units were we used historical costs and considered a rate of return on the city's investments in its rate base. And projections for natural gas production included the city's projected production and asset retirement obligations. Projections for the financial modeling were prepared for a base scenario, as well as 3 other different scenarios. And sustaining capital was projected for each business unit based on city estimates. So as I mentioned, we're not going to go into the detail, the nitty-gritty details. We'd have you here for a couple more hours of all of the options analysis. But just from a high-level summary perspective, looking at natural gas production, we found that it scored best under a divestiture option, assuming that there would be a willing buyer. This is because natural gas production was projected to be a significant drain on city finances, given the high ARO costs and the weak market prices. A divestiture of assets outside urban development areas would reduce the city's requirement to sustain the business. And a divestiture of some of the natural gas assets may be possible, as strategic investors may value the assets differently than the city. From an electricity generation perspective, it appeared that electricity generation was more advantageous as an MCC than as a municipal department. As we've mentioned multiple times, electricity generation is facing low market price outlook and increasing carbon compliance costs, thereby impacting its overall competitiveness, and profitability is currently uncertain. In the medium term, the business unit could be financially challenged, and therefore an MCC board and administration would need to navigate the evolving regulatory and market changes with the aim of preserving and enhancing business value. Electricity and natural gas distribution also scored best under an MCC, and we found that an MCC could provide greater access to capital while maintaining service quality and capacity charges that would be likely be lower than transmission rates.
I have a question about the access to capital.
Can we hold that off until
Sure.
we get into the
Yeah.
MCC? Just because I think it's more advantageous to go through the detail of the MCC, but thank you. I will come back to you, Mayor. In terms of strategic actions, oops, and I'm behind here. Now we're moving into those strategic actions that I mentioned that we laid out based on our options analysis. So if we divide our strategic actions into 2 areas of focus from a natural gas natural gas production divestiture perspective, We recommend an increasing focus on expediting the abandonment or sale of the natural gas production assets. If divestiture is not feasible, natural gas production should remain as a municipal department, and detailed wind-down plans would be required to optimize cash flow. We'll get into the detail of why we think it should remain with a municipal department. A more rapid wind-down of natural gas production may benefit the city financially. Electricity distribution and natural gas distribution, we recommend are moved into an MCC, actually, as well as electricity generation. And we see a strategic action as establishing an MCC to own and operate the distribution and electricity generation businesses. And this action could be supported by additional strategic actions, and that is establishing a rate review committee to support council in your role of approving energy distribution and commodity rates. A second strategic action is to develop a dividend policy and stipulate investment parameters of the USA, or the Unanimous Shareholder Agreement. And so putting those strategic actions into timelines, we see some immediate wins possible. Over the next 6 to 12 months, we think it is possible for council to set up and to establish a rate review committee to support you in your role of approving distribution and commodity rates, as well as increasing the focus on expediting the abandonment or sale of natural gas production assets. Over the next 12 to 18 months, we see it possible in terms of establishing an MCC to own and operate the distribution businesses and electricity generation business, as well as developing a dividend policy where it would be stipulated the investment parameters for the USA, or the Unanimous Shareholder Agreement. So looking at establishing a rate committee. As I've mentioned, we think that a strategic action would be to establish a rate review committee that would be comprised of individuals with relevant experience to support the rate setting process and recommendations. If the city operates the distribution businesses either as a city department or a city-owned subsidiary, it would continue to act as the rate regulator. But the committee would follow industry-accepted rate design practices to recommend fair and competitive rates for ratepayers. And these rates would reflect the distribution business's need for consistent and industry-appropriate returns. Council would delegate rate approvals to this committee to separate the role of council and the rate regulator. Alternatively, the committee could provide recommendations to council for approval. We see the benefits as we are helping to delineate council's those 3 conflicting duties that Tim introduced. This would help delineate one of those conflicting duties and provide more structure and transparency to the rate setting process. It would allow access to more technical expertise. The energy business would get an additional level of technical expertise when establishing rates. But it should be considered that the mandate of the committee, what is the mandate of the committee? Is it an approval body, or are they merely making recommendations to council? And we would leave that up to council on what is appropriate for in terms of a mandate of that committee. The size and the composition of the committee is to be determined, and the development of a transparent rate regulation process that adheres to accepted practices, industry standard practices for rate regulation process. The communication of the rate regulation process to ratepayers and potential interveners. And finally, a budget would be required to establish and maintain the committee funded by distribution rates. So strategic action number 2, we want, we feel that a strategic action to explore the divestment of natural gas production would be worthwhile. The city should increase the focus on expediting the abandonment or sale of the natural gas production assets that are possible to divest. This action could include engaging an intermediary to provide an assessment of the business value and potential attractiveness of the natural gas assets to strategic buyers. However, the city has a regulatory responsibility for ongoing testing and monitoring of abandoned wells licensed to the city within corporate boundaries. These are non-producing assets with potential liability, which likely could not be transferred to a third party, therefore would need to remain with the city. There are producing wells and pipelines within municipal right-of-ways containing other city infrastructure that may also present a barrier to the transfer to a third party. And the city would have continued responsibility to manage these assets. So we see that a full divestiture is likely not possible, quite certainly not possible. As the natural gas production business is in wind down, there would be no benefit in transferring it to the MCC. Additionally, there is a substantial ARO associated with the well abandonment activities that must be addressed by the municipality. The benefits of this strategic action would be that it would reduce the city's ongoing exposure to operating losses from these assets, as well as isolate the MCC from the burden of natural gas production losses and liabilities. Additional considerations could include that the city may not be able to divest some natural gas assets for which it has a continued responsibility, which I've already mentioned, and the city should also prepare a financial analysis to determine an optimal timeframe to wind down non-saleable assets.
So looking at the MCC, as mentioned, this would be a new entity owned by the city, and it would comprise the distribution companies and the electricity generation business. Important to note that even though this entity would have its own board of directors, the responsibility for regulating rates would remain with the city, would remain with council, or delegated to the rate committee that Karen mentioned. We would, I think, a very important element of setting up an MCC would be to get a very strong board of directors that had knowledge and skills relevant to the energy business and could help it navigate some of the very challenging times that we see ahead of it. So the benefits, this improved governance, improved oversight, the improved financial accountability and transparency when we have a separate entity with its own financial statements a little bit more segregated from those of the city, it becomes much more apparent what the financial performance and health of the MCC would be. We suggest that it gives greater flexibility in access to capital, and we will touch on a question there in just a second, and would continue to, by virtue of the ownership being held by the city, it would continue to, any dividends would be returned to the city. I think by virtue of the fact that it is, the city is still setting the rates, the rates would have to continue to be competitive. In considerations, I think we've talked about sort of the importance of having that dedicated oversight and independent oversight. We feel that it would be probably most expedient and least disruptive to continue to leverage some of the city's services, such as currently exist. The energy business uses facilities maintained and operated by the city, and similarly with its fleet, and it could continue to access city services on a fee basis, such as your accounting and legal, those sorts of services. We are assuming at this point, and this would be an area of further exploration, that this, setting this up would not trigger any changes to existing regulations, such as, for example, the municipal debt limit regulation. So I believe before I move on, we have a question about access to capital.
Yes. It sort of seems to me that that's the only immovable or intransigent item. I'm just wondering, what type of capital are you saying that we can't access? And also, to administration, have we had that discussion with the province to see if that's an option? Like, we already have an exemption which is different from everyone else. So if there are additional things that we need to be successful in carrying out the goods and services within that exemption, we presumably have had that discussion with the Alberta government. So first question to you, and then second question to administration.
Sure, very good. So we've been referring to the MCC having greater options or flexibility in terms of financing. And so just to give you a sense of how we perceive that, number one is it would be able to raise its own debt, and depending on how that is done, it may be able to raise its own debt in a manner that doesn't negatively impact the city's debt limit. So right now, there's a couple of parameters that the city must work within with respect to the amount of debt it takes on. And so we want to make sure that we're not jeopardizing those or limiting the city's ability to raise debt for other city needs, the roads and the infrastructure that I mentioned earlier. It's not to say that it's a bit of a complicated question there, but I think that there are many examples where MCCs have been able to raise their own debt and not impact that limit negatively. But then there's other financing options, such as joint ventures and entering into more equity arrangements with other potential investors or strategic partners.
Have you reviewed the major municipalities investment regulation?
Yes, yeah, but which element are you referring to there?
Well, just like our ability to have joint ventures and co-invest with other organizations, buy securities from them, et cetera.
Yeah, so you are able to enter into, and there's precedent for companies entering into, a municipally owned company entering into joint venture arrangements. So.
But I'm talking about the municipality. Like this municipality has entered into joint venture arrangements before.
Right, and you absolutely. But when you enter into a joint venture as municipalities, typically for to attract that investor, it needs to be set up as basically an MCC again, so that the investor has an opportunity to have an ownership stake in the project or in the company.
Yes, I'm just saying that we have done that many times within our oil and gas business for sure. Mm-hmm. So I'm just not sure that that's a change. And so the second question to administration regarding whether we have had the discussions, like some of these hurdles that are being identified, whether we've tried to resolve those hurdles with the provincial government?
Through the chair, I would just say that those questions, I believe, are a bit premature. We don't know what direction council is going to ask. If there is an appetite from council to look into an MCC, then we would go down that road and we would look into those types of things.
I'm not talking about the MCC, I'm talking about the obstacles that have been identified that make an MCC, like why you're recommending an MCC to us. Have we tried to resolve those obstacles that are being stated that they exist now? Have there been discussions with the province to try and resolve those obstacles without doing an MCC?
Through the chair, I would defer to our CFO, but I would say, based on current state, we haven't run into obstacles as of yet, so I don't believe that we have. That being said, I believe KPMG's proposal is a combination of benefits as opposed to looking at just one, this being one of a package of benefits. So difficult to look at it in isolation, but I would defer the specific financial question to our CFO and otherwise defer back to the package of recommendations from KPMG.
Madam Chair, sorry, go ahead.
So through the chair, as a result of this project, we have not approached the province looking for options. However, that's absolutely something that we could do. We have explored with the province, for example, funding our ARO obligation and so forth. So we've been in discussions previous to this project with them on that. Definitely when it comes to our debt limit and looking at other options, the province would definitely be a partner and an advocate for us, I believe.
Councillor Knodel.
Thank you, Mayor Clerk. I'm just going to piggyback off of what you had alluded to in regards to whether or not we would get support. So I am curious if the administration or managing directors feel that if the federal government was to impose, and I understand will impose energy regulations in the future, and if they were to basically terminate our ability to move forward, do we see both provincial and federal levels of government, and I guess this is me asking the same question with different words, do we see them as, or especially the federal government, providing resources financially to make those transitions possible to us? Or do you see the federal government imposing those changes and kind of putting the weight of that financial obligation on us, as opposed to supporting us financially through those transitions?
Thank you. Through the chair, and I do want to be careful because we have asked KPMG to provide an independent review. So I suspect Ms. Barraclaw could provide her thoughts from a KPMG perspective. But my expectations from a staff perspective, I think you're speaking about decarbonization requirements. Typically, depending on which government would be in power, federally or even provincially, often new requirements come with some level of incentives, but not always. But the weight of the burden for investment is typically applied to the business itself.
And maybe just to follow up on that, there are some incentive programs in place and in further discussion with the federal government with respect to decarbonization technologies. Specifically, they've also been tax incentives in place for renewable power development over time as well. But I would also reinforce that, yes, I mean, I don't think you'd expect to see government stepping in and assuming all the costs of decarbonization. This goes well beyond the city. There'd be a lot of impacted parties and investors who have assets that would be impacted by these types of regulations. But I do also think that there's a lot of conversations going on, and I think that's part of the discussion around timelines is, with consideration for capital stock turnover. So, acknowledging that there have been investments made as well, and how to manage that and look at timelines that might, certainly not perfectly and not fully, but might align somewhat with full depreciation of assets and those kind of concepts.
Can I make a follow-up comment? Okay. I appreciate the feedback from both Managing Director Pancoast and KPMG. Thank you. Maybe I should leave my comments for after that. I'll leave it as a question, but that's kind of what I was thinking. It's a big responsibility, and we ultimately will bear a lot of burden, just like any company or anybody else that would be affected by this. Thank you.
Okay, maybe if we can return to the slides. So just for clarity, when we're talking about an MCC on a few matters, just want to make a few things very clear. The city would own 100% of the MCC shares. It would be the sole and only shareholder. It would control the MCC indirectly. The MCC would operate at arm's length, but the city would still appoint the board of directors and would retain any specific authorities it deems important, and these would be codified through the USA. And this is part of the hard work, I guess, the due diligence that the city would want to do as it explores an MCC as an option. Would the city still control rates? Absolutely. That would never be delegated to the MCC. That would create a conflict of interest there. But the city may, and as we are recommending, delegate authority, or at least a recommendation to the recommendations from a rate committee. Would the city still own the energy business assets? And as the MCC would own 100% of those assets, and the city owns 100% of the MCC, indirectly the city would still own 100% of the energy business assets. Would ratepayers still benefit from a single utility bill? So you're very familiar with the fact that one bill goes out not only with the natural gas charges, the electricity charges, but also other city services, water, et cetera. That is absolutely viable and probably would be advisable under an MCC as well. To continue. And would an MCC protect the city taxpayers and from the business risks that we've identified? And it can't fundamentally change the risks, but it can open up different avenues to address the risks and to better navigate with these risks. And so we've highlighted these, right? So the increased governance and oversight to help navigate the energy business using specific skills of people knowledgeable on the board to deal with some of these matters. We've talked about the access to capital and has been pointed out. This is a model that has precedent and has been able to open up different options. And then it has the potential to increase the predictability of the cash flow through an effective dividend policy. We'll talk about that one in just a second, between the city and the corporation. So our fourth strategic action is that dividend policy and some of the other defining or foundational documents to establish a strong and constructive relationship between the city and the MCC. So it's not good enough for there to be sort of ad hoc dividends or to be a lack of a sort of a guiding principle or an understanding between the city and the MCC as to when the MCC and how much the MCC would issue as a dividend. So there's some work that can be done there. There's lots of examples that exist where the principles for a dividend are spelled out in advance, and that aids in the predictability of the cash flow that the city needs and gives the MCC the flexibility it needs to continue to invest in the business. We see that this would be part of and probably referenced in a USA. We've talked about that a lot, and that's the defining document that spells out the roles and responsibilities and authorities of the relationships between the two entities. This is where the council and the city can define what it still wants to retain in terms of its authority, what the MCC still needs to come to council with for approval. And finally, there needs to be a guiding principle or guiding document around when it's appropriate for the MCC to be asking for an investment from council. So where the MCC is not able to, is looking at a very significant opportunity, it's raising debt, it's maybe getting some shareholder, some joint venture partners involved, but there's still a need for additional capital. When is it appropriate for them to approach council for the city to make an investment in that? So understanding those principles from the get-go, I think is going to be very important to have an arrangement that is satisfactory and protects the interests of all parties. So the benefits of putting in this hard work early will protect the financial sustainability of the MCC and give the city that predictability and the authority to continue to sort of assess any further investment requirements. I think we do need to recognize that we are heading into tumultuous times, potentially. And so while we want to have these things defined, they can't be defined too rigidly, that we can't navigate a little bit within, as our environment changes. So working on defining the guiding principles is probably going to be more important than defining specific values, for example. And I think it is important that these are documents that it is appropriate to revisit these from time to time to make sure that they remain relevant and advantageous for all parties. So then, just to sort of sum up in terms of these strategic actions, again, in the next half a year to a year, we think it would be feasible to explore the option of a rate review committee and to establish a mandate there, should the council decide to proceed with that, and to look at expediting the abandonment or sale of the natural gas assets. It's going to take a little bit more work to put into place the MCC and to get some of that due diligence done that needs to be done if that was the option that you chose to explore. And so we see that being a little bit longer time frame, sort of that year to 18-month time frame. To get into some of the more specifics of how we see this unfolding, Karen is just going to walk us through some potential next steps.
Thank you, Tim. So before I get into these slides, I want to emphasize that we wanted to present some potential next steps, but this does not mean that we are assuming that there's any decision that is going to be made in one direction or another. And I would also say that I regret not setting these two slides up into two phases, because I think council can make a decision to proceed in principle to explore an MCC and to explore a rate committee. And then there's some decision points. And at that point, you move from implementation planning into actual implementation. And so these steps consider those two phases. And so if council chooses to move forward in exploring the MCC or a rate committee, it does not mean that you have to choose to head definitely in that direction, that there's an exploratory phase. So looking at the rate review committee first, or the RRC, we see a few steps being exploratory, looking at the mandate, delegations, and composition. There can be a delay on actually enacting a bylaw, but eventually a bylaw would need to be enacted. In that exploratory phase, council could also identify the skills required and even look at recruiting different members, as well as developing the methodology and processes. Obviously, a council would need to make a decision once recruitment actually was taking place. And finally, and this is more, these two are in the actual implementation phase, communicate the process with the public and then start a review of the 2026 distribution and capacity charges as well as commodity rates. Some potential next steps with the MCC is first looking at, in principle, exploring the option of an MCC. Subsequently, the city would look at developing an implementation and business plan, as well as related communications. The city would also could look at the structure to optimize tax and financial flexibility, as well as validating the business case. And then this would move into the implementation, but actually enact structure. Developing the USA and the policy governing the dividend and the city investments could happen in that implementation exploration phase. But obviously the decision to adopt those would move into implementation. And then also in the implementation phase, recruiting and appointing a transition board of directors, obtaining regulatory counterparty approvals, assigning assets and liabilities, looking at developing a shared service agreement between the MCC and the city, talking about those shared services and what that would look like. Finally, confirming and configuring corporate systems, and then commencing operations. So this is just to give councillors, mayor and council, a feel for what those next steps could look like.
Councillor Knodel?
Thank you, Mayor, through the chair. Thank you, Mayor Clark, through the chair. So I am just curious, did you see the MCC as the only model through which we could employ or integrate a rate review committee or board to better guide the corporation through change? Or do you see there room for being that sort of leadership in our current model, and what would that look like?
So there's two separate, you mentioned a board of directors, and then as well as the rate review committee. And so those are two, I want to delineate those quite separately because they would be two separate entities. Obviously, you know, we've gone through the whole process of looking at all of your material, all of the information on what the possibilities could be for the city, and we came down to the MCC as a recommendation. The rate review, that being said, the rate review committee is independent of an MCC, and that's why we made those strategic actions separate. But a board of directors would be part of the MCC versus the rate review committee would be a separate strategic action.
Through the chair, so thank you. The reason I asked that, if I have had a couple community members reach out and say that we need a separate leadership body between council and our current administrative team that runs the Comco or the Genco, the companies that we have, our production and distribution. And the reason I'm asking is so that there's public understanding that in order to have a board of directors, it would have to be under a different model. So I appreciate that feedback. Thank you.
I would, however, suggest that an advisory committee, there are other ways to have input come into council independent of administration than an MCC.
So if possible, that's maybe what I'm looking for then. And I understand your recommendation through the chair is the MCC for that reason. So I understand that we are trying to stay on track with the particular three paths in front of us. But I suppose maybe I will look to Mayor Clark or admin to illuminate what that feedback might look like if we were to stay status quo. And if you have comments, that would be great. Thanks.
Sure. I'll address the advisory committee comment in particular. So a board of directors is different than an advisory committee. An advisory committee is simply advice from a group of experts versus a board of directors actually has an obligation. They are the decision-making body for the organization. So I would say that those are two different options, shall we say.
Thank you. Councillor McGrogan.
Thank you, and through the chair. I don't know if this is the right time, but one thing that's been on my mind is the MCC seems very logical, but I'm just, the places that you name that have it that are municipally controlled, Ottawa, Calgary, Edmonton, Red Deer being closer, I guess, to our size. I'm curious if through the decision-making of this recommendation, if there's been a kind of a cost-benefit analysis. What is an MCC going to cost us, I guess? And I'm not questioning the return value of it. I'm just curious if there's been any question about, here's what's going to cost us to create this layer of expertise that's going to help us run our corporation.
So yes, excellent question. And we did cost it both from a transition, like setting up. There's a lot of work steps to work through, right? And so we did look at an estimate of those costs, as well as sort of what might be the incremental operating costs. I will say that in terms of as a percentage of the business overall, it's relatively small, depending on the options. And I think this is part of what we're suggesting in the exploration stage needs to happen, is a little more refinement of those. But we could be looking at 1 to 2% of revenues, which as I say at this point is a bit of a rough cut, and certainly is much smaller than the sort of the margin where we're looking at in some of the forecasts. So, yeah.
Thank you.
So when you say 1 to 2% of operating costs, that is the additional cost of operating an MCC
Yes.
that you have estimated at this point?
That's right, yeah.
Okay,
Yeah.
thank you. And that is based on the MCC agreeing to use the services that we already provide?
Correct, yes.
Thank you. Is that the end of the presentation? Okay, let's finish off the presentation.
I believe that there was an invitation for others to comment on the question as well, but move on. For the board of directors and the rate, it's okay. We'll move on. And
Managing Director Eager, did you want to add something?
oh, whoops.
No? Okay.
Thank you. Oh, great. Can someone get me to the left? Thank you very much. The pointer was not happy. Can we go to the very last slide, please? There we go. Thank you. All right. To sum up, looking at the conclusions of these strategic actions, we think that these strategic actions will provide the focused and informed oversight and greater access to financing that the energy business will need to navigate this regulatory and market uncertainty that we've described. We see it as creating value by promoting positive investment decisions and leveraging new sources of financing, that the MCC structure could enhance the long-term viability and profitability of the energy business by increasing the returns to the municipality and benefiting the community as a whole. We see that the MCC structure could reduce risk exposure by enhancing governance, providing capital access, and more predictable cash flows. The MCC provides additional checks and balances by strengthening governance and oversight from an independent and technical skills-based board. And it could provide more focused and informed oversight over the direction, the risks, and the performance of the energy business. We think it's important that you minimize these conflicting roles by separating the energy business decision-making from the city to allow for specialized experts to maximize the value on behalf of the city, while enabling the city to focus its capital expenditures on essential municipal services. We think that this will remove that having to decide between a rec center and an energy project, which is is going to be important for the viability of the energy business's future. And that's the end of our formal presentation.
But it's just that someone else will be making that decision, right? Like, it's all the same money. And so it's just that council won't be making the decision of whether we get a rec center with the money we have, but the MCC, we currently have that revenue now. We would be dependent on them paying a dividend to us. And so how they manage, you're still making a choice between two different things. We're just getting rid of some of our revenue and agreeing to take a dividend instead. But that MCC is going to still have to make the same investments that we would have to make.
So I'd be hesitant to say getting rid of your revenue, because you have to set up that dividend policy to determine what that would look like. But I think that council, when you're looking at capital investment decisions, that those energy business capital investment decisions would be part of the MCC planning, and additional financing options would be then on the table to assess those capital investments.
But they will impact the dividend that comes back to the city, which will give us less revenue to work with for municipal capital projects. Or even if it's the same, it's still the same calculation. We're still making a decision about the capital projects based on the MCC having, or our energy company having to make certain investments in the energy company. Does that make sense?
Yeah, do you want to?
Yeah, I think we're seeing it as, right now, you're making capital allocation decisions within a relatively finite pool. I guess it's always going to be finite, but it's a pool of a given size, we'll say. With an MCC, the intent is that it would become responsible for getting more of its own financing directly. So you're actually expanding the size of the total capital available between the two entities, so that it's not being constrained in its ability to raise its own funding for its own assets. Yeah.
But that debt technically is still ours, because if the MCC doesn't work, the debt comes back to us.
So, if the MCC didn't work, if you were to say it was in a position of default, which would be, very unusual on the distribution side for sure, the normal course of action, the normal course of a business would be to liquidate, right? So it has, remember, these are very capital-intensive businesses. They have a lot of assets that would be of interest and saleable. And so the assumption would be that if you needed to exit the business, you would do so through a sale if you needed to, right? The selling the assets. So it's not like you're going to be held, the city's going to be left holding a bag of debt with nothing, right? That would be, I don't think, a realistic scenario, I guess.
If we sold our assets. If the liquidation, you're talking about a bankruptcy, but if we just don't, say another council comes along and says, we don't want to do an MCC anymore, the debt comes back to the city, right?
If the council decided to reintegrate an MCC into the city, then yes, it would have to absorb the assets and the debt, yeah.
Thank you. And when you say that risk exposure will be reduced because of more predictable cash flows. I am not sure I'm understanding that when council still sets the rates.
So what we're referring to there is, I mean, you're setting the rates for the distribution side, the distribution rates, and for the commodity prices. The volatility is going to be on the generation side. And so what you have is a potentially volatile, or the energy business has a potentially volatile net earnings or cash flow. So in any given year, it would be able to pay a higher or lower dividend, right? And that's fine, that's normal, that's expected for a commodity-based business. That's difficult for a municipality to budget around, right? They want a little bit more certainty and predictability in the cash flows. And so a lot of times the dividend mechanism that is set up tries to accommodate that, right? So that you're not subject to the same swings as much.
So are you talking about predictable cash flows for the city or for the MCC?
In terms of the dividend policy, it's about the city's, what the city can predict in terms of its the cash flows associated with the dividends it will receive.
Which are still subject to how much the MCC makes, right?
Yes, but what we try to do, or what utilities often do with their municipal shareholders, or even shareholders in general, is to minimize the swings, right? So that they're going to say we're going to be paying a certain dividend, and we know that that dividend is going to be a higher or lower percentage of our net earnings in any given year, but it's a level of cash flow that we can commit to and still be sustainable.
Councillor Hirsch.
Well, certainly the presentation tonight's with the questions as a result seems to be already bordering on debate. So the lovely thing about that is it tells me that there's more work to be done. So I appreciate that. I guess, a lot of the questions that have been asked is exactly kind of what the next steps would mean. I am prepared to, I've got a series of motions that I would like to put on the table, but certainly want to leave enough time for questions before I make the motions. But I guess in putting on my banker's hat, it is difficult for a municipality when you talk about capital options in terms of just the flexibility of a municipality is just not there compared to, say, an external corporation that can offer shares, can do whatever, it could be whatever it is. You could get debt instruments, that sort of thing. I know part of the next steps might be conversations and looking down in terms of what an MCC could be, or perhaps conversations with our provincial government friends that says, okay, in terms of debt capacity, what does that look like? Can we get an exemption? I'm not so sure, I guess those are conversations to happen, but I'm not a bit pessimistic in terms of the ability of the provincial government to say, we are going to allow you to have an increased amount contrary to the MGA. But anyway, that's another conversation for another day. I guess the other question relative to what Mayor Clark was talking about as well is that the presumption of caliber of talent between this city council and an a board of directors that are, to your point, I can't remember what slide it was, you talked about what that looks like, and it is a skill-based individuals that sit on that board. So from a decision-making standpoint, I think you're talking about two different subsets. I mean, we've got people from different walks of life here, certainly not in the energy business, but yet that's exactly, the utility business, but certainly that's what we would be looking for in a board. Is that fair to say?
Yeah, yes, I mean, I think there's a suite or a combination of skill sets. Understanding the utility business, commodity markets, generation technologies, those are definitely core to it. I think strong financial acumen and understanding a capital market is going to be very important as well.
I do have a question that is, I guess, more opinion from yourselves than maybe fact. It's funny, I was in Washington DC last year, and I watched a city bus go by, and it said, proudly powered by natural gas. So for me, politically speaking, and this is going to be opinion, it's not based on the presentation, but would there, and you kind of elaborated it on a little bit, that between the tier, between everything, the clean energy, et cetera, in terms of what we have right now, it is becoming more and more of a headwind, I get it. But would you feel, based on me watching a billboard go by of a bus that's powered by natural gas, is there, by your opinion and seeing if there's political wins that would look like natural gas, which is a clean burning entity, but in some cases people call it a fossil fuel, depending on who you talk to. Is there a chance that any type of legislation could be to say exempt natural gas? Because I think we all agree, I hear it all the time. Solar's not reliable, wind's this, and then we need a base. And I guess I'm wondering, in your opinion, is that something that has legs, or quite frankly, it's a fait accompli in terms of it being labeled as a fossil fuel?
And, you know, I think we can probably take some lessons from what we're seeing in even ISO's forecast, right? And natural gas is still a component of their long-term outlook. I think it's changing. I think it's you know, the degree, the amount is you know, not what we would have expected to see. You know, if we roll back time 10, 15 years ago when everybody was moving away from coal and natural gas was the, you know, the clean burning alternative. The other thing is, and so you know, there is this uncertainty, right? And I think what you're saying is really underscoring that. And you talked about sort of the, you know, might it be needed to provide the firming capacity with all the renewable? And I think that's when Sean talked about some of the changes we might see in the energy market in Alberta. When we talk about these sort of these other ancillary services, that's the kind of thing that we don't know what that might look like, but there could well be opportunities for specific natural gas assets to play there. And some of the characteristics of the city's fleet might fit quite nicely in some of those services, where they have a very rapid you know, cycle time.
But realistically, and thank you for that, but realistically, no one has a crystal ball. I just, you know, I kind of look at, based on the presentation tonight, I guess the challenge is when I think about our involvement in the last 100 years, directed by city council, et cetera, that's status quo. But when I think about what the future is, it's everything but, not status quo. Political headwinds, environmental, carbon tax, financial, lower prices due to ample supply, governance challenges, et cetera. So it's a lot to think about. I'm absolutely pleased that you were going to be able to present tonight, and just want to basically thank you for the presentation.
Councillor Sharps.
Thank you, Mayor Clark. I just have 4 questions, and I apologize if you actually answered them, but maybe I just missed them in its entirety. So I guess my first question is, you know how we will have budget asks will come to council and Managing Director Pankos will say, hey, we need $250,000 or we need to. Would that go away with an MCC, or would that ask still come to council? Or would that ask be going to the Board of Directors going forward?
So under normal circumstances, we would envision that that would not come to council, that the MCC would, that the Board of Directors would be providing that oversight as to whether or not that's an appropriate expenditure for the benefit of the company. And this is maybe where it does come directly or indirectly to council, is the rate review committee needs to be looking at the appropriateness of capital expenditures from the perspective of, is it necessary? Because obviously investments in rate base affect rates, right? So there's 2 perspectives on looking at that, but neither of those are the city's perspectives. So the role of council as council, you know, looking at it in relation to the rest of the council capital budget, or the city's capital budget. I will qualify, there's one exception to that, and that is, you know, it could be that down the road there's you know, very significant opportunity to make a substantial investment that the energy business may, it's beyond sort of normal circumstance for it. It may come to the city to see if there's merit in investing in that. But I think that's, with the parameters of that and when it is appropriate for the MCC to ask for that, need to be worked out in these early stages.
Good. So in essence, it would be responsible to manage and operate itself just like a business
Yes.
accordingly. Okay,
Correct.
that was my first question. With the board of directors and appointing of the board of directors, I'm assuming the city council or the city would retain the ability to put like an interest group at the table so the citizens felt heard. So if we wanted to allocate a seat, could we do that?
You have the ability to, to define the composition of the board, absolutely.
Okay.
The other area that you have the ability to do so is designing your rate-setting process so that there is potential for public intervener involvement in the rate setting as well.
Okay, perfect, thank you. There's only two left. Yeah. I have a question about alternate energy. So let's say in a year, we went down the MCC road and then 6 months later we want to get into solar. Would solar be separate, or because this is an MCC, would solar go under the MCC for them to manage? Because I feel like there could be some confusion there.
Right, yeah. And, the short answer, there's an option there, but I would suggest at that point, you have an entity that specializes in the energy business, right? Knows how to make those kinds of investments, build those kinds of projects, and actually manage the output of that facility. So it would, and it's already set up as a separate entity with appropriate oversight for that. It would probably be wise to take advantage of that. But
I would agree. I just didn't want to. I wanted to make sure it's out in the common discussion area. Absolutely. And then my very last question is: you mentioned 1%. 1% of what? Like, what does 1% equate to?
Yeah. So that was of revenue. Yeah.
Oh, okay. So that's right now fluid. It's a very fluid number.
Yes. I mean, okay. I was rounding a little bit there, but we're in the one, depending on the scenario, 1% to 2%. Sort of thing, but that is something that we need to refine in terms of an exploration of the next step here.
So, sorry, go ahead.
Sorry,
yeah.
and some of the considerations that go into that would be, what would you see the composition of the board being, for example, right? And the more interests or more perspectives you're trying to accommodate, the larger the board, the more the costs, that sort of thing, right?
Sure.
So there's a little bit of, we got to figure out what that operating model looks like before we can actually put a hard cost to it.
Okay. Perfect. Those are my questions. Thank you very much.
Councillor Dumanowski.
Through the chair, thank you. Like others, I have questions around some of the conversation tonight. Thank you for this very thorough, very robust conversation. So I have questions that are varied. They do not necessarily indicate where my position is, but I'm going to ask them because I know general public probably would, so bear with me. So one of the questions was touched upon was the access to debt limits and debt capital in order to, or debt limits and funding in order to access capital and whatnot. So I'm going to leave that one. At one point you had alluded to discarded options of governance models, but they were out of scope. It piqued my interest when I heard that. It's like knowing what's behind the door. Or there's something behind the door, but we can't show you because it was out of scope. Yeah. Fair or unfair question. Can you generalize why or even though they were out of scope, and I understand why you had to maintain discipline and stay in scope, are those, the curious side of me wonders if those were options that would be on the table had they been part of the scope. Can you just generally speak to that so that?
Yeah, no, it's a great question. And the answer is fairly straightforward, really, because so the options we were looking at, for example, a society. And a society would not be able to earn a profit and distribute that back to the city, right? So that it wouldn't be possible for a society to be issuing a dividend. Another one was the rural electrification associations. They, we're not dealing with a rural area, we're dealing with, with the city. So it was very technical reasons as opposed to anything to do with, I guess, sort of values related to the outcomes. It just wouldn't work technically.
I appreciate that. Thank you. I'm going to continue. The makeup of the MCC executive or board of directors, there's been a few questions around how would that be determined? Who determines ultimately? Because one could argue, if you want to have them be persuaded toward a certain thought, you could populate it with people of like thinking, and conversely the other way. How do we ensure the integrity and variety of membership, and who decides that ultimately?
Mm-hmm. Great question. And I think there's really two elements to that. First, bottom line, you do. It's council that appoints the board of directors. So it would be you that would decide who would be on it. I think best practice or good practice is to take some time to think about what is it we're trying to achieve with this board of directors. What do we want out of it? And defining a priori, what skill sets are we looking for, right? And what kinds of perspectives do we feel is appropriate to give us comfort they can give this entity appropriate oversight. That helps provide a little bit of discipline to the discussion, but ultimately it's council's decision. Yeah.
Okay, if I can, a few more questions here. So moving maybe forward, I'm going to skip a couple of questions since it touches on another one, and that is the current system where we have, and I'm just going to say it, we've had past and present experienced professionals working and running, we'll call it running our utility, in the sense that they, in their own divisions, bring forward the challenges, the opportunities, the future thoughts around what we need to do in order to maintain that utility heritage, that publicly owned pride that we have had for over 100 years. Councils past and present have been served well by those entities. So again, I'm just asking for the sake of the question, why, obviously over that time, we've had staff who are highly competent, exercise when needed, external experts, KPMG, other energy experts, when it came to investments or divestments of assets, not, even though they have the expertise in their own disciplines, they sought, I would imagine, the expertise of others outside. Why is that kind of a model less capable or less enabling for the future of our utility versus the thought of moving to an MCC with a board of directors?
Mm-hmm. It's a great point, and because it is, it has worked for many, many decades. I think I would answer that in two ways that are sort of interrelated. I mean, the first, we really highlighted the scope and degree of change we're now facing. And I would suggest that, well, you have, a team that has served you well and they're very knowledgeable in the energy business. They could benefit from support from others that know that, can more perspectives on how do we navigate this, right? In a very informed conversation. But I think that sort of also leads me to sort of the second is there's going to be, you as council, the complexity that is being asked of you in terms of understanding and staying abreast of all these issues and what they mean for the energy business, et cetera. It's, the amount of investment that you're going to be needing to make. I would suggest it's going to be significant if you want to maintain appropriate oversight. And so this is a mechanism to help you with that.
Continuing, thank you for that. Again, I'm asking these questions just for the sake of public consideration. Mm-hmm. When it comes to the creation of an MCC, I believe I understood that there, in theory, could be an MCC developed for the electric side of our energy business and a separate one for gas, or would both be under one board of directors?
So I would suggest, and there's an option to develop for each. I think that adds a little bit more complexity and overhead to what could be a fairly integrated still energy business. The only thing we were excluding was the natural gas production, just because it has its own challenges. It's in wind down mode, and with the ARO burden, it didn't really seem feasible or a fit for the MCC. But I think if you're investing in that enhanced oversight and governance, it would make good sense to apply that to all elements of the business.
So just to clarify, sorry, outside of the, so they would be one or two? One, okay.
Yeah.
So, I guess I'm pleased with that because my thought was if they were separate, that, I mean, simplistically speaking, and I'm going to speak very simple, but historically our kind of natural hedge, we used to always say in Medicine Hat, was when electricity was high, gas was low, and we had this natural embedded hedge that safeguarded the city when we went through the ebb and flow of ups and downs. The market is completely changed, and you alluded to that. No one can argue with that.
Right.
My understanding would be then, or my thought was around.
Sorry, maybe if I could, I may have been unclear there. So the natural gas production would stay with the city, and so that the electricity generation and the two natural gas distribution and electricity distribution would be with the MCC.
Right.
Yeah. So you wouldn't see the natural hedging in the energy business itself, although if there was a benefit there, the city would see it overall. But with the level of natural gas production, I think, no matter what model you choose, you're going to see a lot less of that opportunity.
And just so you know, I'm speaking figuratively.
Oh,
not,
okay,
not
sure.
literally.
Okay, gotcha.
So the natural hedge that,
Yeah.
So when it comes to the rate setting committee, and I know that's a separate entity, I just contextually, I can appreciate that. In particular, during that spike, we as council and staff have experienced unprecedented communication from the public. We'll call it that. One of the arguments, and I'm asking this kind of to challenge the notion of the creation of a rate setting committee, although I'm not saying I'm opposed to it. So is it essentially the function of it? Because as I understood it, the membership would be some expertise mixed with some public personnel, et cetera, and there would be opportunities for growth and learning, and ultimately the makeup of it would essentially be derived of the same shared knowledge that people would have both on an expert level and a lay person's level. I'm trying to understand how, other than the deep political maneuvering that it does in its essence, in its creation, fundamentally, and this isn't about a slight to myself as a counselor or past or current counselors or future counselors, but we essentially deal with the same inputs and challenges that our staff bring to us, and rarely are we, I can say this, I've been here a while, have we ever been completely offside? They may disagree, but I can't imagine, I can't think of any situation where we were fundamentally in opposition to any direction or recommendation from our staff. So in essence, we would have an independent group who would give information or be presented with the same inputs and outputs as a current council and still be tasked with recommending the rates, if you will. Other than the, obviously the political maneuvering that goes with that, what significant benefits are there? And I'm just asking that for the sake of the average person out there.
Oh, absolutely, and it's a very valid question. So I think what we're advocating here is, or not advocating, what we're suggesting, is that such a committee would be a group of individuals that would have the focus, opportunity, and longevity to really learn the ins and outs of rate setting. Right, and so if we think of councils do have a typical turnover every 4 years, this could be a rate setting committee might have a more typical, tenure of 6 years, for example, if there was a 2-3 year appointments or something like that, staggered. So you have a little bit more longevity of the knowledge, and the only thing that we're asking them to do is understand the rate setting process. And again, unlike council, it's being asked to understand a heck of a lot about the running of a city. I would suggest that what we've seen in the past, and this is just fairly high level observation, might to us suggest that there could be more rigor in the rate setting process. So, for example, we highlighted the fact that there's been no use of rate riders in the past, right? We highlighted the fact that there was some discrepancies in the amortization in 1 year. These sorts of things, with a very knowledgeable committee that would know what to look for and what to ask, might help catch some of those things as well, right?
I think I have one more, Your Worship. The current utility exemption, I think it was touched on, and it might have been answered, but I perhaps missed it, or if you can just elaborate. So the current exemption, everything that's being proposed, whatever council decides to do, explore these options, and whether this and future council decide to pursue any formal recommendation after that exploration stage, if that's what we decide to do. Do we jeopardize any of our exemption statuses, or I know there was some alluding to the investment side of things through the mayor and others. What vulnerabilities do we currently enjoy that could be jeopardized or compromised by moving in a different direction, if any?
No, excellent question, and one that warrants even further sort of exploration as well. But I think what we talked a lot about in our own analysis was the exemptions. There's multiple under the Electric Utilities Act, but also the other one that came up when we started talking about the debt limits was looking at the different debt ratio that the city enjoys compared to other Alberta municipalities, right? And there's four or five municipalities that have a preferential ratio there, right? So would those sorts of things come into jeopardy if we were to make substantive changes? And I think right now our assumption is there's nothing obvious to suggest that they would automatically change. That said, there needs to be more due diligence there, and also we need to recognize that these things are always, changeable as deemed appropriate by our politicians. So,
thank you for answering those questions.
I don't see any further comments, but I would like to make, this is just a comment, not a question for you, but as you pointed out, this is a longstanding business, a very fundamental piece of the city's heritage, and it is our utility. It's our energy production and distribution. And so I do not think that this council should be making any decisions before consulting the public that we serve. So that is my comment. Councillor Hirsch?
With that, I think I'm in a position now, if there's no further questions, I'd like to make three motions. I didn't know, Madam Chair, if you want them all together as individual or individually?
Can you, I don't know what, oh, you're waiting for them to go up on the screen?
No, I can read them. I guess, and maybe what I'll do is read them, and if you want to vote on them independently, we can, or we can do it all together. It's your choice. But so motion number one is that City Council accepts and receives the KPMG.
Can you just go a little bit slower so that the
certainly.
Clerk can keep up? Oh, they're all done. Okay.
Certainly, thanks. So that City Council accepts and receives the KPMG Energy and Business Strategic Report and related KPMG recommendations as information.
I'll second.
And further, that City Council directs some, oh, sorry.
Can I suggest that we, someone make a motion to take a 10-minute recess so that Counselor Hirsch can provide his
I can make
motions
that motion.
Okay.
I'll second.
Thank you. We'll vote.
Just, if I can make it 5 minutes, I actually have to head out of town tonight. So if we can make it 5 minute,
Yes,
So, good.
5-minute,
perfect.
sure.
Thank you.
Okay. Any objections? Nope. Okay, we're taking a recess. Right, we will come back to order, and Counselor Hirsch has a couple of motions that he would like to make.
Thank you, Madam Chair, and I appreciate the patience of, as she wordsmiths my series of motions. So at this point in time, I would move that City Council accepts and receives the KPMG Energy Business Strategic Report and related KPMG recommendations as information. That's my first motion.
I'll second that motion.
I was the one who took that off. I'm just, because we've already received it for information. I thought we stopped doing motions to receive things for information.
Okay.
Because we already received it, like, we have received it for information.
That's fine. It was just traditionally that's what we did, but that's fine.
But we don't actually have this presentation and report. Email today?
Correct.
Okay.
Very good. Thanks for that. Second motion is that City Council directs administration to consider and evaluate the KPMG review and provide City Council with recommendations.
I'll second that.
And lastly, that City Council hold a special meeting or a council meeting by December 9th, 2024 for administration to present evaluations and recommendations regarding the KPMG Energy Business Strategic Report.
Okay, so we have a motion and a seconder for the first paragraph. Is there any discussion on that motion? All right, we'll vote. That's unanimous. Now, the second motion that was read out by Councillor Hirsch, do we have a seconder on that?
I second it, Mayor Clark.
Okay, any discussion? My feeling is that December 9th is too soon. We're in budget. We've had a lot of extra meetings. I would like to push it to the new year after we've dealt with the budget and staff has dealt with the budget. Well, I don't want to, I am working on budget too, so I feel like it's a little bit onerous, but any other comments? Councillor Hyder?
Thank you, through the chair. I know everybody is tasked with lots of things, but I think this is just my opinion. I'd rather get it done before the end of the year.
Okay, I'm not sure. Again, I would like to reiterate that we, in my view, this needs to have public consultation associated with it, and that can't happen before December 9th. Councillor Van Dyke?
Yes, thank you, through the chair. So if administration were to present the evaluations and recommendations, that doesn't necessarily mean that we would then also have to act on them at that meeting. It would be a presentation to the community, which it could percolate and people could contact us and whatever until after budget in January, right? So in my view, it would be just getting the information out into the community, yeah, to let people know. And then it would give the public time to let us know as well. Because, I mean, it is a busy time of the year and people are preoccupied.
So if the public feels that they need to be consulted on this, they need to send us a load of emails before December 9th?
No, sorry. So admin would bring their recommendations, which we would receive at that meeting, and then, but we wouldn't, this is my understanding based on this motion, it would just be brought to us, but that doesn't mean we would be motioning or passing. It would just be for maybe information with action to come in the new year.
Well, anyone could make a motion. Councillor Dumanowski.
Yeah, just to concur with Councillor Van Dyke, I mean, as I understand it, we have had a presentation tonight by KPMG. We ask questions. The public will have heard the same presentation, but there is no direction at this point. We've just received the report, so that would be our opportunity to hear from staff and then give some validation in some capacity to what the next steps are. That would be the trigger point, in my opinion, for the public to give input, which is absolutely important and valuable, and I completely agree with you.
City Manager Mitchell?
Thank you. Through the chair, and I think one of the bigger questions is, would staff be able to prepare this? And I would say the answer is yes, we would, given the nature of the fact that Managing Director Pancoast has been working through this process for over 10 months. I think we could meet the timelines. Thank you.
Councillor Hirsch?
So the struggle I had in terms of timing, it's kind of like the adage on, you know, hot porridge, cold porridge, just right. And in my mind, the timing of this, I think there's some energy, even with the discussion tonight, there was some energy in the room in terms of having a well-intentioned discussion, and I feel postponing this for over, quite frankly, almost a month and a half, because arguably we're going to get into January, the first week's a bit of a write-off, and then all of a sudden we're in the middle of January. So my concern is that the temper would get, or the fever from which we'd need to have this discussion is going to be lost. And I think it's important, again, when, in fact, you kind of made its own point, and other council members as well, by having the meeting and having the recommendation, it allows us to get to that next step to say, what does that look like? Because right now, we just received a report. So we have to digest it. I want to be able to digest it. I want to have the ability for staff to come forward now, because there's been some heavy lifting in regards to them working with KPMG over the last few months. So I think it's important, and I think staff, quite frankly, are comfortable and ready to have that discussion. Nothing concrete as of yet, and all it is the next step in having a discussion to which the public now can be served with some information in terms of some recommendations. So it is, quite frankly, the next natural step.
I'm not arguing that it's not a natural step, just the timing of it. I'm going to vote against it because of the timing. I think it's too short. And I also very much doubt that the fever of this issue is going to be reduced over time. Councillor Robbins.
Yes, thank you, and through the chair. My observation is that the community has heard the report today, but they have no idea what city administration thinks about it or the city's input, and I think that will lead to a lot of questions and speculation, and we've certainly seen that before. In fact, in the council before us, when efforts were made, for example, to put out some ideas of what some downtown restructuring might look like. And then there was these assumptions that's what the city was going to do, when that was never the intention of city administration. So I think that the short timeline for me makes sense, so that the public can know earlier rather than later what the city administration's recommendation is to council about this. That's not what necessarily what council is going to do without public input, but at least it'll stop the speculation of what city administration plans to do. So if city manager says that can be ready to go by December 9th, before December 9th. It's a very tight timeline, but I think it would end some speculation in the community, which would be helpful. So I'm voting for it.
All right. No further speakers. We'll vote. And that passes. There is no further business, so are there any, no. So we will, are there any objections to adjourning? Seeing none, we are adjourned.